Hello, and welcome to the July 2025 edition of the U.S. Energy Insights. I am your host, Pamela Munger, and I'll be taking a look at the latest trends and market conditions within U.S. and global energy and sharing actionable insights powered by Vortexa's tracking analytics. In this insight, we will take a look at what is happening in the Atlantic Basin oil markets following the last few weeks of high geopolitical uncertainty. Why has the oil market pricing returned to normal levels? When will distillate cracks settle? And what is the outlook for PADD 3 crude and refined product seaborne exports? Now, the recent conflict between Israel and Iran witnessed a realistic threat to the Strait of Hormuz, a location where 20 to 30% of global oil flows transit. And despite oil prices moving up only $5 to $8 per barrel, the market showed a great deal of resilience, quickly realizing the ample supplies available to the market, which was keeping the prices in check. Now, assuming that the 13.4 million barrels a day of crude that was exported through the Middle East Gulf through the Strait of Hormuz was lost, and that's an average of the last 12 months, global crude in the supply chain could easily cover such a situation for 13 months. And we think markets quickly realize that. Now, if we take a look at all products in tanks and tankers and all observed oil in tanks and tankers, they show relatively high levels, either at the top of the seasonal range for products and at the 5-year average for all observed oil in tanks and tankers, which were above last year's values. Now, despite rumors of signals jamming and elevated war risk premiums on freight rates, there was no shortage of tankers and little disruption in overall flows, or no more than usual for the zone, which often shows volatility in a short-term basis. Risk drives up market sentiment, leading to substantial gains in spot freight rates. And as we can see, weekly tanker transits via the Strait of Hormuz continued at a high rate, reaching the top of the seasonal range. So what is happening to Iranian crude and condensate loading and discharges? Crude flows via the Strait of Hormuz remain essential for Asian refiners with limited alternatives to replace disrupted barrels in the short term. In the first 12 days of the month before the Israel strikes began, Iranian loadings reached a record of 2.4 million barrels per day. Iranian crude and condensate on the water hit new highs amid record loadings in early June. That also meant that Iranian crude and condensate on the water had risen to new highs above 120 million barrels per day in June, and that's despite a quicker discharge into China. Now, loadings have slowed significantly since June the 12th to around 600,000 barrels per day, but have not stopped. And while cargoes are moving east quickly, Iranian discharges into China have also rebounded, rising from May's low of below 1.1 million barrels per day to an estimated 1.7 million barrels per day in June. This uptick in discharges is helping to ease tanker tightness, and thus Shandong's onshore inventories are expected to continue building in the coming weeks. Meanwhile, supplies in the region are growing, as seen here by OPEC Plus increasing seaborne exports on a 28-day moving average basis. Now, we have seen higher seaborne exports from both Saudi Arabia and the UAE in line with the unwinding of voluntary production cuts. China can also rest easy, knowing that recent decision to deny U.S. refiners Venezuelan crude has meant that they will be able to sell that heavy crude into China, where it will likely be the only realistic outlet. Meanwhile, the Atlantic Basin remains oversupplied with light sweet crude, with more production on tap in the second half of 2025 amid slowing demand, with higher loadings expected from Norway, Guyana, and Brazil. Now, the Argentinian pipeline and terminal expansion are also pushing 1 to 200,000 barrels per day of light sweet crude, with terminal expansions expected by August 2025 in the Puerto Rosales terminal, for the Puerto Galvan expected terminal in the Puerto Galvan. There's a terminal that is expected to be capable of loading Suez Max vessels once completed in 2026. And a bit further out, Punta Colorado terminal will also be capable of loading VLCCs with completion expected in the second half of 2026 or further beyond. Now, these Argentinian volumes will most likely end up in PADD 5 in the near term. Now, despite crude prices falling back relatively fast after what we are now calling the 12-day war, we have seen a sustained strength in middle distillate cracks. On the one hand, we have observed longer maintenance season in Northwest Europe. However, it is likely the unplanned outage at the Haifa refinery in Israel and the power generation needs in Libya, Egypt, and Greece, alongside fears of Middle Eastern supplies being curtailed, have underpinned the recent surge in middle distillate cracks and margins. Now, given this strength in cracks, Europe remains well supplied with middle distillates even before the summer travel season really goes to a start. Now, looking at PADD 3 crude and diesel exports to Europe have been a beneficiary of this near-term Mediterranean demand and have given freight rates a boost from the US Gulf Coast. Rates for transatlantic MRs jumped largely due to a supply-side push, given the 25% week-on-week increase in PADD 3 diesel exports headed to Northwest Europe at the end of June. Momentum for TA MRs is expected to continue, given sharp upward movement in freight rates and reports of continued strong fixing activity out of the US Gulf Coast. Now, ARA gas oil stocks in June are lower year on year, despite soft diesel demand forecasts in Western Europe, but not too terribly low. Record import demand in the Mediterranean could increase Europe's overall need for additional external barrels. Diesel and fuel oil import demand could also increase in the Mediterranean due to high power generation demand. And with the high diesel volumes moving to the Med, including Russian diesel, this leaves Brazil open to buy diesel from PADD 3 as imports fall below the seasonal trend, and we see a rising share of diesel flows from the US Gulf Coast heading to the country. Well, that's all we have for you today. Thank you very much for joining, and I hope to see you on the next US Energy Insights.